Welcome back to Curious Commerce. Topic Fund Flow Statement, Part 7. Today we will discuss about schedule versus fund flow, non current item changes, and fund from operation. While studying fund flow statement, learners often get confused between two terms schedule of changes in working capital and fund flow statement. They look related, but they are not the same. Think of it like this. Schedule tells the effect on working capital, fund flow tells the movement of funds. Today's session, we will clearly understand the difference between schedule and fund flow statement. Let's begin. First, let us understand the schedule of changes in working capital. It is a statement that compares current asset and current liabilities of two periods. Its main purpose is to find increase in working capital or decrease in working capital. It only deals with the current asset and current liabilities. It does not show sources and applications of funds. The schedule is only a supporting statement, not the final analysis. But the fund flow statement is a statement showing the sources and applications of funds between two balance sheet dates. It gives the answers from where did funds come and where were funds used. Fund flow statement shows the fund from operations, issue of shares, purchase of fixed asset, loan repayment, and increase or decrease in working capital. Fund flow statement gives the complete picture of fund movement. On the basis of the purpose, schedule of changes shows the change in working capital only, but fund flow statement shows sources and uses of funds. Let's revise quickly. Schedule means change in working capital. Fund flow shows the movement of funds. Schedule is the supportive statement. Fund flow is main statement. Schedules comes first. Fund flow comes late. So learners, now the difference between schedule of changes and fund flow statement should be crystal clear. While preparing a fund flow statement, we do not look only at working capital. We must also study changes in non-current items. Why? What is the reason? Because these changes tell us the major sources and applications of funds. In this session, let us understand the important non-current item changes. Non-current items are long-term assets and long-term liabilities. They are not expected to be converted into cash within 1 year. Certain examples like fixed asset, share capital, debentures, long-term loans. If changes in these items usually involve movement of funds. Let us understand the most important one is purchase or sale of fixed assets. When a company buys machinery or land or building, cash or fund go out. It is an application of fund. Sale of fixed asset. When a company sells machinery or building, cash comes in. It is a source of fund. You should be memorized with using that the purchase means it is application, the sale means it is a source. Purchase means applications of fund, sales means sources of fund. The second non-current item is issue of shares or debentures. The first one is the issue of shares. When the company issues new shares, money comes into the business. It is the sources of fund. Similarly, when debentures are issued, company receives money, it is also a source of fund. It means raising capital means sources of fund. The third non-current item is loan raised or repaid. When a company takes a long-term loan, funds come into the business. It is a source of fund. Opposite to that, when the company repay the loan, funds go out, it becomes an application of fund. Let's revise quickly. Purchase of asset, that's the application of fund. Sale of asset, it's the sources of fund. Issue of shares and debentures is the sources of fund. Loan raised, sources of fund. Loan repaid, applications of fund. These are all the very important for fund flow problems. Fund from operations. Many learners confuse with net profit, but remember, net profit is not equal to fund from operations. In this session, let us understand the concept clearly. Fund from operation means the funds generated from the normal business activity of a company. It shows how much fund the business created through its core operations, not through financing or investing activity. It is the adjusted operating profit that actually contributes to working capital. We start with the net profit, but we must make certain adjustments. Why? What is the reason? Because net profit includes many non cash and non operating items. Therefore, how to calculate the fund from operations? The calculation follows a clear platform. The first step is starts with the net profit. Take net profit from the profit and loss account, add non cash expenses. We should add back expenses that reduced profit but did not use funds, such as the depreciation, amortization, loss on sale of fixed asset, provisions for taxation, sometimes as per the situations. Because of these, do not involve actual fund outflows. The third step is deduct non operating incomes. Now subtract the incomes that increase profit but are not from operations, such as profit on sale of fixed assets, dividend received, and interest received. The final result is after the adjustment, we get fund from operation. This figure appears on the sources side of the fund flow statement. Remember the formula. Start with the net profit, add non cash expenses, deduct non operating incomes. The end result is fund from operations. End of the session. Today we already discussed about the schedule versus fund flow, non-current item changes, and fund from operations. In the next video, we will learn about fund flow statement preparations. Please like, subscribe, and share. For daily updates, follow WhatsApp channel Curious Commerce Financial Management Hub. Thank you all.